So I'll go into two examples of our 10 principles. One of the most well-known principles that we have as one of our 10 is the law of one price, which states that two assets that are identical, they give you the exact same cash flows, the exact same thing. They have to have the same price. Otherwise, financial markets may break down and there could be an arbitrage. And so this is a principle that ties much of our book together. For example, we start providing examples of, let's say you're an appraiser trying to value houses. It's a guiding principle that shows that the basis is if you have two identical houses, they should have the same price. But it's in all three parts of the book. For example, in corporate finance, a big focus is looking to value corporations and various companies. And so the law of one price is a guiding example that underlies all of the valuation models, saying we start with the base case of two companies that are identical in all respects, and then we adjust for differences between the two as appropriate. And then it also is featured prominently in financial markets. For example, any financial asset, such as a stock or a bond, again, if they provide you with the exact same cash flows, they'll have the same price. That's our basis. And then differences in the cash flows and differences in the characteristics will provide differences in the valuation of the two. Now, another example of a principle is the principle of flexibility. One of our core principles is that flexibility has value in financial decision-making, and the more flexibility, the more value. And this is something that is very key to finance. Finance, one of the main things about finance is dealing with uncertainty. The world is uncertain. We don't know what will happen in the future, but much of finance is about dealing with that type of uncertainty. And so this principle underlies both the development of options in the book and also has many applications throughout the book. One example of this is in corporate finance. For example, when you're a manager in a company trying to make decisions in the future, you don't know what will happen in the future. There's a lot of uncertainty. And so the more flexibility you have to, say, change your decision after more information comes in, the more valuable that opportunity is. And so these are two examples of principles amongst the 10 that, again, we try and permeate throughout the book and tries to tie all of the topics together.